Hi, Chris Duff over at Sirius Land Capital, vacant land funding partner. Today I wanted to go over one of the creative financing techniques that we use within our funding business and allows us to take a look at potentially more deals than we may consider otherwise. And this particular item that I'm going to comment on today is called a pre-profit fixed allocation. Effectively, that means a preferred return, but we're just talking about absolute numbers versus a percentage. So it's just kind of like fancy finance speak for meaning effectively the same thing. So to break it down as simple as possible, and then I'll get into how we use this strategically. Is say there was a deal that the purchase price on it was 100,000. If we were a little bit more concerned about the exit price on it, we might ask for, say, a $5,000 pre-profit fixed allocation, which I'll just refer to as a fixed allo for short going forward. And effectively what that would mean is that when our firm, upon exit of the sale, assuming it is a profitable sale of the property, we would get all of our principal back plus any associated expenses with the deal that were related to closing costs, etc. And then out of the remaining gross profits, we would effectively take the next $5,000 that's available out of those profits first, and then the remainder of profits past that $5,000 initial slug is going to be split to whatever profit split that we had determined before. Let's just say 50-50 for example there. So that effectively allows us, it doesn't necessarily protect downside, it's more of an upside protection, because downside protection, you need a lower price overall on the property, no matter how much upside you might preserve. If you're buying at the right price, like, your downside's not protected. So it's more of an upside protection mechanism for us to ensure that we can hit kind of the baseline multiple on invested capital that we're typically looking for of roughly 20% or 1.2x at least net multiple on invested capital, or MOIC for short. We can try to reverse engineer that with conservative anticipated exit price and how we might build in a fixed allo to reliably hit that number and make our dollars at work worth our time effectively. So we tend to use this approach, I wouldn't say a majority of the time, maybe like 1 out of every 3 to 4 deals at max might be considered with a fixed allo in mind. And as anybody knows who's been in land for even a short period of time, like the market's the market. There's really no guarantee you're going to get a certain exit price, no matter how good your underwriting is. Markets can change. Something may have come up from a DD perspective after you already buy that just kind of disturbs the value of the property. Maybe other more superior properties come onto market after buyer pool just dries up for whatever reason, seasonality, like there's a million reasons for why things don't go exactly according to plan. And so, whenever we see that there could be a higher variance outcome for the dispo price, and a lot of this is informed by the other comps on the market. We always are looking at our characteristics in relation to the comps and seeing how they compare. Are they more superior versus inferior? If they're more superior, then we're more willing to take a risk and potentially less need for a fixed allo. The more inferior the property is, the higher risk, the higher variance outcome potentially, the more likely we would want to build in a fixed allo. And if we see a pretty significant gap of price per acre within a certain market, and tough to differentiate even between characteristics, like, say, just for example, like the price per acre for exits of property in the area was like between $23,000 per acre. Yes, if you examine it more thoroughly, like the $23,000 per acre exits probably are more superior on average, but potentially they have longer days on market, um, or the differences were just a little less stark than we might imagine, or maybe the ones that sold for 23,000 an acre sold closer to a year ago versus the ones that sold closer to 11,000 an acre or right around there were a bit more recent. So you have to balance all of these factors in mind to determine, okay, where do I need to be on a price per acre perspective to be conservative enough to really protect my, anticipate protecting my downside. And so we're always going to try to determine that first and then figure out, okay, what's the seller dynamic here? Is there any room to negotiate further? If it's just a hard stop, hey, no, this deal's not happening unless you hit my number, then we really have to determine, okay, is there room for us to do a fixed allo without taking too much risk on the deal? So usually we won't go above roughly 60% purchase price of conservative market value. Like that's usually a pretty firm guideline there, plus or minus a percent or two potentially, depending on the underlying market. And, in those cases where, there might be more inferior characteristics related to the subject or more variance in the market, then to try to preserve that upside a bit more, it's like, okay, we could buy at that price that's sitting at maybe 60% of that conservative value, but build a fixed allo onto it, try to preserve our upside. And the way we try to make it even more fair for the land investors who work for us is that, okay, if there's a high variance here, then if we're able to generally double the purchase price in a gross sense, pre broker fees and closing costs, etc., then we can effectively hit kind of a stop limit for when that fixed allo is taken into account. So, say we had that $100,000 price deal and we put in kind of that stop limit again of, okay, if this property, sells for over 200,000, we have to agree that, that there is a chance it could sell for that. Like, is it worth listing above 2,000 to see if there's any buyers on the market? If that makes sense, then yes, we could set the initial list price there. And if it truly exits at that number, then we just waive the fixed allo, because then we're still going to be satisfied from a multiple on invested capital perspective, and still try to preserve more of the upside for the land investor who brought us the deal, so they're not penalized for a higher range outcome in a higher variance market. Whereas, if we have to start cutting price or we just don't find the right offers at that higher range, then we have that fixed allo to protect us. So we have all of that built into our docs to allow us some flexibility and try to provide as many fair solutions as possible, and allows us to do more deals than we might otherwise be able to participate in, when we can kind of have some more flex with the numbers there. So hopefully that gives you an idea on how we operate from that perspective. There's some other creative techniques that we also have I can get into in another one, but wanted to share that just because we're heavily looking at doing this fixed allo again on another deal in Texas here shortly. So it was kind of top of mind, and I know people ask about this a lot, to allow for more flexibility in deals. So hopefully that gives you an understanding on how we utilize it and kind of the rationale behind it too. So beyond that, as always, if you're looking for funding, Sirius Land Capital, or zero cost review of your land deals at Land Daily Diligence Facebook group. About to just did some yesterday, some very large deals, and then we'll be back on Thursday, so that's Monday and Thursdays. And landpricer.ai for the most simple and accurate way to price land. The pricing feature is basically fixed. There's like one more small bug that just needs to be adjusted. That'll be ready by tomorrow morning, but I just tested out a lot more. The engineering team is really closing in on wrapping this thing up, so beta test invites, I'm actually going to be reaching out to people even later today. So FYI on that. Looking forward to next time. Subscribe and share. Take care. Bye.